Okay, so now I'd like to take a look at a number of questions related to tax calls, and some of the questions are here, and maybe you want to pause it. You pause your video just to look at the question, and there is actually another question on the next page which I'm going to try and answer. Okay. So I'm not very clear about tax call. Could you help to explain further? I checked Google and find some clues, but still confused. Well, you can't use Google for everything. Google can tell you how to make a good cup of coffee, yes, but Google is not the answer to all questions. Now, actually, in answering the previous question, I will be explaining, basically what a tax call is. The tax call is something that is related to withholding tax, or WHT for short, withholding tax. So the tax call, the word tax in tax call refer to the T in WHT, or withholding tax. Now, what actually is that? So you have to understand that this is something which normally applies to foreign investors buying the bonds of a certain country. So let's say this is country X, and there in country X there is ABC company, and it's issued a bond to local investors, investor A and B and C, okay? And let's say the bond is paying 8% coupon. Let's just say it is, doesn't matter, okay? 8% coupon to A and B and C. Now, so if you're a foreign investor, so you're investor D, but you are not in that country, so you can still buy these bonds, and then you still enjoy the coupon, okay? Now, the problem is sometimes governments, so the government of this country, okay, doesn't matter who it is, country X, the government of country X, they can suddenly say that they want to put on a tax on, maybe dividends and also bonds that are paid to foreigners. They do that, okay? So I'll give you an example. So for instance, they might say, all right, from now on, we are going to put a 30% withholding tax on all, dividend payments and bond coupon payments leaving this country. So if you are local, then maybe you are not affected. But if you are overseas, then you'll be paying 30% on 8%, which means suddenly you have lost 2.4% as tax. Now that tax actually quite often it is withheld. So that is why it's called a withholding tax. What I mean withheld is before the money even leaves the country, before it even leaves the country here. So the government has a means of withholding 2.4%. So in the end, only 5.6% of that 8% coupon is able to leave the country and go into the foreign investors' pocket. The other 2.4% are withheld, okay, as a withholding tax for foreigners. Okay, now here we have a problem. So the problem is, all right, well, the government wants to charge a tax, but who's going to pay for it? Government's not going to pay for it. They want to be paid. Okay, now the issuer doesn't want to pay for it. The issuer, the obligation that they have is that every coupon period they pay 8%. That's it. That's their obligation. They are paying 8%. It's just that out of this 8%, now suddenly there's a whopping big tax, which wasn't there before. Okay, I'm talking about maybe you issued a bond here, okay, and maybe it's a 10-year maturity, and then maybe 2 years later, suddenly the government changes their regulations now, and then tell you, okay, from this point onwards, we want to charge withholding tax on all the bond coupon payments. Okay, now if they were okay, now so if the government wants to be nice about it, they can say that, all right, from this point onwards, only the new bonds that are issued will be subject to the withholding tax. They can say that, but you know what? They don't have to. Okay, they can suddenly just say, all right, all bonds, new or old, is going to be subject to a withholding tax. Now you have a problem. Problem is the issuer doesn't want to pay. Well, why should they pay? They just pay 8%. That's it. Okay, and then the investor is very unhappy because they buy a bond fully expecting the coupon to be 8%. Okay, I mean they may be paying some other taxes on that, but that's not really the issue. That's not the point here. Okay, just assume they're not. But suddenly, their coupon has been reduced by 2.4%, which is a lot. Okay, so you have a problem. Everyone is unhappy. So the way they try to deal with that is right at the beginning, on issue date, there will be some information in the prospectus, in the offering circular, where the issuer will say, okay, in such an event, if ever the government imposes a withholding tax, we will simply call back the bond and pay back at par, and then we just forget about this transaction and it'll be over and done with. Okay, now that kind of solves the problem in a way, okay, but it's not a perfect solution, and I'll explain why in a moment. Okay, but at least if you are the investor, you don't suddenly get a reduced coupon. Okay, you just get your money back, and if you want to still invest in this company, you can look further at a later stage. So that is the tax call, so to speak. It's simply when a government imposes a withholding tax on certain fixed income instruments that are already out there. There is the provision that the issuer can call it. Okay, now note that there are a number of different ways you can do this. For example, a tax call can be unconditional, so the issuer will call them back, all of them. Okay, another way to play that will be the issuer will give the investor a choice. Okay, either I call it back and pay you 100, but or you can continue. But if you continue, please note that your net coupon income is now going to be substantially less. So your choice. Okay, now I need to explain that part because it is connected to one of the questions, which I'm now coming to. So issuer has tax call at early redemption amount, which is typically 100. Doesn't have to be. Okay, that's fixed income. It can be anything you want. It can be 102 if you want. Okay, but don't worry about that part. Does it mean that issuer can get a tax shield because it pays out debt principal to investors in advance? Well, I don't know about this question. This tax call thing is not something that you need to look at from an accounting angle. Okay, it is simply a feature. It's a fixed income feature, and you have to understand the purpose behind it, which is not. I mean, there are accounting implications, but that's not the focus here. The purpose of the tax call is to give investors some comfort that if they buy a bond from this company, if they are a foreign investor and they buy a bond from this company, in the event of changes in withholding tax laws, they can be repaid earlier, and which is better than getting stuck there suddenly with a lower coupon and then not knowing what to do about it. Okay. Tax call will deprive investors of option value. What does this actually mean? Well, look, if you had a bond and you bought it at 100, now it could be that in the next couple of years the bond price rises to, let's say, 103, and it's not really option value as such, strictly speaking, but at this point maybe you have a very good feeling about this bond and it could go to 105, you think. Okay, who knows? But now you know it won't, because they're going to call it back. They're just going to call it back at par. So whatever happens in the future is now none of your business, because you don't have that bond anymore. And that is what it means when the tax call will deprive you of any option value. Or I think a more appropriate way to say this, maybe the tax call will deprive investor of any future potential gains, any further gains. You won't have any further gains. You're going to get your money back. Okay. Some investors may want to suffer consequences of withholding tax and not have their bonds redeemed. Now, what this means is, let's say you buy a bond and really is paying 8% coupon. Now, this is probably something that you get from emerging markets, and it may be that just as I said just now, even after they put on a withholding tax in year 2, it could be that, first of all, you are still okay with a coupon of 5.6. Maybe you are still okay. I mean, it's not good. Okay, suddenly you lost 2.4%, but you may be okay with it. You may be okay with it for a number of reasons. Okay, reason number one is what I just told you, that this bond is currently trading at 103, and maybe you think it can go to 105 or 107. So you might want to keep it, even though now your coupon has suffered a whopping big deduction of 2.4%. That's reason number one. Reason number two is, if you are a foreign investor, now imagine you are American. Okay, so your base currency is US dollars, and let's say this bond is issued by a company in Brazil, let's say. Okay, and I mentioned Brazil for a reason, which I'll come to in a moment. So this bond will be issued in Brazilian real. So it's a local currency bond. You may have a very, very positive view on the Brazilian real. So if you hold this bond, even though your coupon is now suffering a 2% loss, maybe you think the real is going to appreciate another 10% in the next 3 years or so. So you might want to keep the bond for that reason. You don't care that you are losing a little bit of income, because you think your view on the currency will be correct. Now, this is something that you have to be aware of. So when you buy bonds, quite often, especially international fixed income, it isn't just a matter of analyzing credit. You also, if you are a foreign investor, you are likely looking at it also from a currency angle. Whether the currency of that bond is likely to appreciate relative to your home currency. Okay, if it is, then maybe you don't mind keeping it, even if the coupon was 0, which will be a very extreme case. Okay. an example for the whole process. Well, I think I have told you the whole process. The process is very simple. Okay, process is company pays 8%, but part of this 8% is actually withheld. So let's say 2.4% is withheld before the money even leaves. So as a result, the issuer will offer to call the bond back and pay back the investor at par, and then everybody will just go home, and then the transaction is finished. Okay. The other question here is asking me to explain. Now, I guess I have explained. This one here, it's just English written in a very complex manner. The rule requires the withholding of cash in instances in which the conversion rate adjustment, unaccompanied by any cash payment, result in taxable distributions. Oh man. All that means is the rule, okay, so first of all, there's a rule which requires the withholding of cash. So 8% is paid, okay? They're going to withhold 2.4% in instances in which the conversion rate adjustment, well, I suppose they what they're talking about is conversion rate adjustment. They mean the tax, okay? But the tax is not paid yet, unaccompanied by any cash payment, because the tax is not yet paid. Okay, that results in taxable distribution. Okay, distribution means the coupon. Okay, so that 8% is taxable. In other words, all it means is if they pay 8% and there needs to be a conversion, let's say a 30% tax. Okay, and if that tax is not yet paid, it would result in this 8% coupon being taxable, and then 2.4% will be withhold. Okay, so it requires the withholding of cash. Now, all this time, I've been talking about the what part. What is tax call? What is withholding tax? Okay, the what part isn't really that interesting. It's the why part. Why are we doing this? Okay, why? So we know what the feature is. Okay, but why do governments why would they suddenly impose a withholding tax? It doesn't seem a very nice thing to do. Now, I'll tell you why. So this typically happens when there is, and this is a common occurrence in the emerging market. What is an emerging market? Well, 新兴市场, right? Now, what is an emerging market? Something like Turkey, okay? Something like China, something like Russia, something like Brazil, something like India, okay? Now, the problem with emerging markets is that when there's a lot of money, flowing around in the international financial system, frequently that money finds its way into emerging markets because it's high yield, high risk, high return. So when things are going well and when interest rates are very low, then a lot of money. So for example, if you are a US investor, if you're an American investor, you sell all your dollars and you want to try and go into markets like Turkey or China or Brazil. And when you sell your US dollars and buy Brazilian real, for instance, and then first of all, the currency goes up. And then when that money goes into the country, all the asset prices go up. The property goes up, the bonds, the equity, everything. And now there's a word for it typically. It's called hot money. This is what governments don't really like that. including the Chinese government. Okay, they don't want hot money. If investors come into a country, they are very welcome to, but they are welcome to come into a country for real sort of investments, like invest in the factory, invest in some land, or build a shopping mall, that kind of thing. The problem with hot money is it can come in quickly, it can go away quickly. So as a result, quite often governments don't really like it. So how do they deal with it? How? They deal with it in exactly the way I've described to you. They try to impose a withholding tax. Now, you have to understand this doesn't happen so much anymore in the current market environment. What we have actually is the exact opposite. Okay, so interest rates are going up, borrowing costs are rising, so there's not really a lot of money going around. Investors or international investors, which are mostly denominated in US dollars, they are leaving emerging markets. So now we have exactly the opposite, of what I described to you earlier. But there was a time, 5-7 years ago, when there was so much money going into emerging markets that those governments thought, oh man, we have to do something about this. Our currency is rising, we don't like it. The property prices are rising too fast. Okay, and then the asset prices are rising too fast. Inflation, is rising too fast, so they impose a withholding tax. Now we don't have that. Now, I mentioned Brazil earlier for a very simple reason. They did exactly that. You can look it up on Google. Okay, they imposed a few years ago. They imposed a withholding tax overnight on their bonds, and if you buy a bond that was issued by a local Brazilian issuer, and if it has a tax call, then I guess they will pay you back if you want to. Okay, so that's the background of it. Okay, so I hope you understand not only the what part. The what part is not really so interesting unless you have the context of why and how a withholding tax is supposed to work, and how the tax code is trying to get around that problem. Okay, so hope this is helpful. Thank you, everyone. Bye bye.